go. Let's do it. Okay. Okay. Well, I can start first just to introduce myself. My name is Carrie Godfrey. I am located in Tallahassee, Florida, and I am a part of the PHP Agency as a financial advisor. And I also work for the Department of Health.
My name is Coach Denise, and glad to have Carrie to be able to, we're going to be tag teaming and being able to provide information to you about financial wellness. Now, sometimes people don't think about financial wellness, but we're here to educate families, you know, of how they could be able to structure their finances, also to be able to protect themselves and protect their money, because usually families are accustomed to a certain amount of money coming into the household. And so we want to be able to show you that if something happens to either one of you, you want to make sure that your family can still be able to maintain the type of living standards that you're accustomed to. So I came into the PHP company, and just by the way, PHP does stand for People Helping People. My name is Coach Denise. Again, I started with the company in February of this year. I recently retired from the state of Florida after 26 years, and now I'm doing this business full time. And it is such a joy to do this because it's allowing me to have more flexibility with my time. I love the money that I make in this business. You know, we offer services to families free of charge. You know, we don't charge the family anything because our carriers are the ones that pay us. But I love the freedom that it gives. I also love being a full-time entrepreneur because it gives you so much flexibility. So I'm going to turn it over to Carrie. There's PHP does have two sides. It has opportunity sides and also what we do for families. So tonight what we're going to do is just share with you what we do for families. And then if you'd like to know more information, we will let you know how you can contact us, usually on social media. You can contact us and we will be happy matter of fact, we'll put the information in the chat box. You can contact us, and one of the things we do offer is a financial lifestyle strategy where we can set that up for you so we can be able to help you to develop a financial plan. So if you don't have insurance, or if you've not checked your insurance for quite some time, then it's good to do a financial checkup. If it is, you need to plan for retirement, and you don't know if you're going to have enough money, or you don't know if you have enough of the different things in place to be able to help you during retirement, we can actually sit down and kind of talk to you about that to make sure that you can have some things kind of in place for your future. So without further ado, I'd like to introduce Carrie. She is a phenomenal she's actually a licensed insurance broker with our company, and she's going to be able to share some information with you. So Carrie, you can take it away.
Okay, thank you, Coach. So here we have today's realities. And if you see, these are the 5 main items a lot of Americans are having to deal with these days. And so we see at the top, we have insufficient insurance protection. And did you know roughly 95 million Americans do not have life insurance? And I find that so shocking because we have insurance or coverage on our phones, on our homes, but not our own lives. And so this is the shocking number that many do not have protection and many are not covered. And then also we have the alarming debt. So we have student loans and credit loans, credit card debt. And so since we can't see any of you, but how many of you, are struggling with any of these areas, either student loans because you had to go to school and had to take out a loan or had to take out something to cover your tuition and board, or even credit card debt to take care of your finances. So this is also another alarming issue in today's reality. Also, there's the matter of the depleting pension funds. And did you know that if you're in Florida and you work for the state, if you pay your funds into a pension plan, it doesn't actually go to the balance. It actually goes to the administrative fees. So did you know that? Exactly. That money is not going, it's not going to the balance. It's actually going to the administrative fees. And so we also see here, there's this statistic that roughly 149,600 benefit plans have actually dropped to 37,906. So this shows that there's actually a depletion of funds, and there's not a certainty or security in where our money is being placed. And also we see over here, there's the failing Social Security. And in the state of Florida, we're actually $48 billion in debt as far as Social Security is concerned. And so it says here, the combined trust fund reserves are projected to become depleted by 2034. So we see here with these realities, with these today's realities, this is what we're all facing, or what maybe many of us have been concerned about, that where's our money going, and is there actually a possibility that our money could actually run out before we retire, before we leave our job, we retire after 20, 30 years, will we have enough money to take care of our debt, take care of our finances, to not have to downsize, to live comfortably? So, and also we have the disturbing reality of the lack of financial education. And so many Americans do not have a financial plan in place. So it's about 60 to 70%. And I know for me, my personal experience, what really got me interested in becoming a financial advisor, a financial broker, is that growing up, I wasn't taught about money. I wasn't taught about how to save money, how to grow money. And so going through school, I was taught just that pipeline, just to go to school, get a degree, get a good job, graduate, and retire. But we see with these 5 realities, just even consider your own situation. Even consider, the matter of any of these areas. It definitely affects each one of us. So can you see the scary state of not having a plan in place? Definitely.
I definitely can.
Yeah, thank you.
Especially during this pandemic. I mean, there is so much going on until people are waiting for life to go back as normal, and it's just not. And so what we do is help people. We're like a bridge. We help you to be able to cross over to, what's new, because life is not going to go back to what we have known in the past. There's actually, just as Carrie just mentioned, all the things that are happening. And so we help you to be able to restructure things, because there's a lot of people are out of work. A lot of people, when they lost their job, they lost their insurance. And so they're like, okay, what are we going to do? We don't have insurance. We don't have a job. And so we have some solutions. So make sure you reach out to us, and we can kind of share what it is that we have in place.
Great. Now we have the many and the few. And so we see on the left, you have the many. So these ones, they make an income of 0 to 999,999. This is their income. This is about 90% of Americans. And they invest their savings, their money, in three products. So the bank, their debit card, their savings accounts, and their CD. And these products, these savings accounts, actually render an interest of about 0 to 3%. So that's not much growth. And these ones usually we see that they are usually renting, so they don't own a home usually. And at age 65, they're still working. They're still working to take care of their debt. And so you have the few on the right side. These ones are making about $100,000 a year, about 10%. And these ones actually are investing their money in products that actually yield compound interest, which is mutual funds, real estate, and insurance. And we see that these products actually bring in an interest of 4 to 12%. And the trend is that these ones actually are homeowners. They're actually, at age 65, they're retired. They don't have to go continue working. They have the option and the freedom to actually be able to retire and take care of whatever needs they need to take care of. So here we see the matter of compound interest. So does anyone know, have you ever heard of compound interest? Yeah, definitely. So we see that with compound interest, this is a way to act how money grows. And this is what the wealthy know about how money grows. So we see here at the top, you have 10 years. And in 10 years, if you have a $30,000, if it's at a 4% interest rate, it's gonna go to $37,459. If it's at 8% compound interest, it's gonna go to $46,936. And so if you didn't know, there's actually a high cost of waiting. And we see here at the bottom, there's an example of a $1 million retirement goal. And so we see here, there's a breakdown, and there's this matter of the rule of 72. I don't know if you know it, but the rule of 72 is actually how long it takes to double your money. And so we see here that if you have 40 years, if someone gets a retirement plan in their 20s, they are making a payment of $286.45 a month, and that's until they retire. But as they continue to wait, as you can see, 30 years, it goes up to 670. It just more than doubles. It just goes up to 670. And then 20 years before retirement, it's about 1,600. And so we see here, and also at 10 years left to retirement, it's about 13,000. So I don't know about you, but I can't afford to wait. And I wait until, 10 years before retiring to actually be able to put something aside.
Right. So, and so what they're looking at there is that this is just a projection of, if you had that as a $1 million goal, you would have to put aside that amount of money in order to be able to reach that goal. And so you don't want to wait until you only have 10 to 20 or 30 years left, because the cost to be able to put it away might be too great, especially when you have expenses to be able to still maintain. The quicker that you're able to start planning for your retirement, the better it's going to be, because it gives you more time to put money aside. And it also gives more time for interest to grow, your money to grow based on the interest rate, which is more guaranteed that you'll likely hit that $1 million goal. And one other thing that we'll mention, which we'll tell you about a little bit later, is that when you're growing money with what we show you through like an annuity, you don't have to worry about losing the money like how you would through the stock market, or you put money in stocks and bonds or mutual funds. Those products are subject to the rise and fall of the market. We're showing you how you can be able to put your money in a financial product where you don't have to worry about losing money.
Yes. So now we see, if you look to the right, here, these are the partners that we work with and we're signed on to. These are the carriers, the insurance companies. So I don't know if any of you know any of these companies. We have National Life Group, AIG, American National, and Mutual of Omaha. And here, these are the products and services that we offer to families. And so we see here, we have life insurance. So there's term insurance, there's universal life, index universal life, and guaranteed universal life, and final expense. And over here, we have our living benefit riders. And so I don't know if you know this, but riders actually, they are extra coverage that are given when someone gets a policy. These are the coverage items, the riders that go along with that. And so right here we have critical illness, chronic illness, long-term care, and terminal illness. And so one of the great benefits is that we don't know what can and what can't happen. And really what insurance provides is that coverage for impact. And impact can happen at any time. And so I remember there's one guy who actually, he ended up having a stroke. And he ended up needing coverage because we all have bills. We all have we have to take care of our payments, our bills, things like that. And so he wasn't able to work, which would subject him to even, losing his living, losing his home and everything. So, but actually him having a policy provided that coverage. And so the insurance company actually gave him a 6-figure check to be able to take care of his payments for a certain amount of time. And he ended up, seeing the power of insurance. There's definitely power and protection when you have that coverage there. And so that's definitely a benefit of insurance. And so we also do 401k rollovers, IRAs, Roth IRA rollovers, and we also provide debt solution. So if someone is considering, even now with the pandemic going on, a lot of people are focusing on getting their debt in order, decreasing their debt, taking care of any type of financial issues. And so we definitely offer assistance with that. And so PHP, one thing I love about it is not an insurance company, it's a financial services company. And so it takes care of all these different these products and services, so of anything that you may need. And so even right here, we have this chart. It gives the difference between term insurance and permanent insurance. And I don't know if you know, but many of us, we have term insurance already, and it's actually provided through our employer. And so with term insurance, the thing about that is through our employer, as we're working on a job, the policy is not actually, it doesn't belong to us. So we have the policy, we have the coverage, but it's as long as we are an employee of the company. As long as we're giving our time, paying our time, this is a benefit that the employer provides. And so, but actually one thing I'm really impressed with is that with term insurance, when you have your own policy, your own term policy or your own policy, you're able to take that with you. You're not bound or subject to staying on a position or a job based on this benefit, having term insurance. And so With term insurance, it's the coverage is between 10 to 30 years, so it's limited. And so after 10 years, if you get a 10-year plan or a 20-year loan policy or a 30-year loan policy, once it ends, you have to get another policy. You have to renew. And so at that point, you're older, and therefore the premium actually increases. And so what we do is we actually educate families. We educate families on the matter of getting permanent insurance. And so with term insurance, it's also a simple application and there's a low initial cost. And so with permanent insurance, there's tax advantages. So if you need to take out a loan or a policy loan, this money is not, it's not taxed, it's tax-free. There's flexible premiums. The premium does not fluctuate. The premium actually stays level, and there's equity and there's liquidity. And so with, for me, I know that when I was younger, you know, growing up, I always knew that life insurance was just based on getting a death benefit. It's basically when I die or when anybody dies, it's the amount of money that's given to the family to take care of whatever needs to be taken care of. But actually, life insurance, I don't know if you know this, but life insurance, especially permanent life insurance, it offers the option to have liquidity in your, it's like it's an asset. Basically, if you need money to take care of your debt, take care of your mortgage, if you want to take a trip somewhere, take care of your child's education, it provides that option. And so I love that about life insurance, that it provides another way to build wealth and another way to grow money and also to keep your money as well.
You know, and one of the things that I noticed, Gary, is a lot of people don't notice you can use insurance to grow money. Just like you said, I always thought insurance was that you get it so that when I die, I can have something to take care of my final expenses and give
Yes.
the rest to my family. Nobody told me that there were living benefits. I mean, that is a reason why they call it life insurance and not death insurance.
Mm.
You look at the type of, like one of the things you talked about is being able to grow money. I know that I got one of our signature products, which is called an IUL, Index Universal Life. The way it works is that it's similar to a whole life policy. So for example, if you had the whole life policy, and let's just say you had $100,000 worth of coverage, and because it does build cash value, you have $30,000 in cash value. If you borrow $10,000, you know, of the cash value and something happens and you passed away, if you have the whole life policy, you know, they would subtract that 10,000 from the 100,000 and your family would only get the 90,000. Well, the remaining of the 20,000 that's in the cash value would go back to the insurance company. Well, when you use the IUL, the Index Universal Life, which is also known as a LIRP, Life Insurance Retirement Plan, that same $100,000, if you borrowed 10,000 of your cash value, if something happens, you pass away and you didn't pay the 10,000 of the cash value back, your family would still get that $100,000. Not only that, they would also get the cash value of the $20,000 that's in there as well. Now, I know I have a grandson who graduated from high school this year. You know, he's 18 years old, young, vibrant, was a football player. One of the things he said was, Grammy, I don't want to be like you and Pawpaw, you know, and retire when I'm working a job for 30 years and retire when I'm not 60. He said, I want to retire at 45. And so we heard him. So one of the things we did was we got him a $500,000 policy. And so that way we can actually leave wealth to him. What I mean by that is because it's going to build cash value. What this means is that when he turns 45 years old, he'll have close to $400,000 in cash value that he can pull from. And when he pulls that money out, he's pulling it out, you know, tax-free. So, because when I mean, my father passed when I was in the 9th grade and he didn't leave me any money. My grandparents who raised me, they died when I was 21. They didn't leave me any money. So my husband and I, we decided, you know, we want to be able to leave a legacy to our kids, you know, not only just money, but also the financial wits for how to navigate this world and be able to still be able to manage money and grow it and know how it works, so that they can also leverage the system too in growing money. And one of the ways to do that is through insurance. What I like about it, by putting it through insurance, is that you don't lose money. The other thing I like about it is with insurance is that if something happens and you pass away, you don't have to worry about probate. The other part is that if you were to ever get sued, guess what? If you have all your assets through insurance, they cannot sue you. They can't get your assets out of insurance. But if you have a 401k or if you have any mutual funds that are outside of insurance, they can sue you for those. So that it provides a lot of security when you're growing your money through insurance.
Great. Oh, thank you for that. So here we see what the wealthy do. So here we have these three markets. We have the index market, the variable market, and the fixed market, and they all represent these three lines. And so here we see the blue line is the fixed market. So these are your debit accounts. This is your savings account, your CDs. If you see this line, it's gradually going up, but it's only going up at a 0 to 3% interest rate level, just a little bit. So there's a little bit of growth, not much. But here you see the red line, this is your variable market. So this is your stocks, 401ks, and your IRAs. These products are actually subject to the market. So we know that as the market is rising, you see the level, it's rising up. But as the market drops, the money drops. And so that money doesn't come back up, it doesn't grow, it just stays, and you have to kind of start from where you are at that point and kind of start to build again. And I know, a coworker of mine, she ended up losing about $50,000 in the stock market, and it wasn't recovered. She just lost it. And so this is where these products, this is what happens. It fluctuates, it varies based on the market. But here we see the green line is the index market, and this is where insurance is placed. And so you see that as the line is increasing, as the market drops, it actually doesn't drop with the market. It's not subject to the market, and it actually stays level, and that's what we call a zero floor. And so as the market is dropping, your money, you don't lose any money. And that's the power of insurance, is that when you put your money into the insurance, in insurance, your money actually, it doesn't drop, it actually grows. And so as it's growing, as it's level, and as the market starts to increase, then the money goes up. So that's one thing I love about insurance. I just got a policy about a couple of months ago, and that's one thing I really love, just to have a guarantee and security that what I'm putting my money into, this product, insurance, I know for a fact that it's not going to drop. I'm not going to check it and then all of a sudden it's all gone. That's the power of insurance, and that's the power of knowing what products to invest your money in. And so here we see, just want you to consider, these are 3 life-changing events that are going to possibly happen to each one of us. If you die too soon, need a death benefit. And this is to take care of those who, remain, your family, your children, your grandchildren. And if you become disabled, you need a living benefit. And if you live a long life, you need income. And we always need income. We always want something to cover us while we're here, taking care of our finances, so we can live, not living paycheck to paycheck, but actually living a life, a comfortable life. I jumped the gun. Here we go. So here we see the matter of taxes. And who doesn't love taxes? No. But the matter of tax. Anyway, Shan, no.
Nobody like taxes. We know that's 2 things for sure. That's death and taxes, and we don't like either one.
Not at all.
Exactly, no. But here we see the matter of taxes now, tax later, or tax advantages. And so did you know that whatever products you use, whatever you put your money in, it's very important to know the matter of taxes related to that product. So we see here savings accounts and your CDs, these items are taxed now. And so the benefit of that is there's liquidity there, the money's available whenever you need it. But the con is that it's taxed every year, and it's actually the dividend that is taxed every year in these items. We see here with the 401k, the IRA, the 403b, and the annuities, these items, many people, they put their money in these products because instead of being taxed every year, they'd rather be taxed later. But actually, the con is that you'll be taxed either way. It's not now, but it's later. And so, but we see that there's an advantage of having life insurance, Roth IRAs, and municipal bonds, because there's no tax advantages. There's no taxes. It's basically tax.
So the way that works with the tax advantages is that when you have life insurance and it's growing money, like I was telling you how I have that policy for my grandson, when he gets ready to pull that money out, he can pull it out as, if you see that last line where it says retirement income is income tax-free through policy loans. He's able to pull the money out of policy loans. He doesn't have to pay it back, and he's not going to be taxed on it. And so when I would learn this, I was like, man, this is better than a Roth IRA, because with a Roth IRA, you're putting the money in after you pay taxes on it, but it is going to grow interest, and that interest is taxable. So when you pull it out, you're still going to pay tax. Whereas if you put your money in insurance and it's growing money that way, you're not taxed on it when you pull it out. Now, because you are pulling money out, it is going to increase your amount of income for the year. You may have to pay taxes at the end of the year, but this is why we teach you to have a business. When you have a business, you have tax write-offs. So we're sure teaching how Donald Trump does his business. All right, take it away, Carrie.
Right.
Right. Thank you. Yeah. So here, this is the dime method. And so this is what we use here at PHP. We to educate families and help families to get their finances in order. We do a financial analysis, which is definitely available to contact us. And we definitely lay out the matter of debt, income, mortgage, and education, because we all have, in some sense, these 4 items that we all face. And so this is what we use to help clients to be able to know what their obligations are and what kind of coverage they need to take care of these matters.
Yeah, I'd like to add one other thing to that too, Carrie, is that one of the things we do offer families is what's called a financial lifestyle strategy. So when you look at the dime, we'll see. We'll let you know. One of the things, well, you do have it recorded, so yes. So one of the things with the financial lifestyle strategy, what you're looking on the screen is that these are things that are common to most families. Most families have debt, they have income, they have mortgage, and they have education, more than likely. But if something happens to them in this example, you see that here's a client, one of them has a salary of $50,000 a year, the other one has a salary of $40,000. Well, if something happens to them where, one of them passes away, well, guess what? There's still debt that's still left behind, and so is a mortgage. And what we do is we show you how to make sure you're insuring that. So if something happens to you, then the insurance will actually pay off the debt, pay off the mortgage. Also, we show you how with the insurance, you're able to have that same amount of income that comes in the household 5 or 10 years down the road. And in this example, the couple decided, hey, I want that income to be able to be to my family for the next 10 years. So this is why you see it says 10 times income. So when we sit down to be able to find out what's important to you, the first thing we ask you is, what is it that you want? What's your goal? Is your goal to have money for retirement? Is it to build money in the case of emergency? Is it to pay off debt? What is it that's very important to you? What are your top 3 goals? And then we're able to show you how you can reach that goal. And one of the ways we do is with the dime and also with the financial lifestyle strategy, which both, of course, is free of charge because we want to see families succeed. And this is what are called people helping people.
Excellent. So here we have annuities. So annuities are basically a tax deferred insurance product, and it's where a person may be provided income for life. And so here's a little bit on the side. There's about, we all know Benjamin Franklin, but did you know that he actually left 2 annuities in Boston and Philadelphia? And we know that Benjamin Franklin, he passed away, I think, 1793. But his annuities lasted until 1993. And so they're definitely long lasting. And we also see with the lottery system, I don't know if anybody plays the lottery, but with the lottery system, they actually pay through lump sum or annuity. And so the way annuity works is that you pay into it, the annuity, either a single premium or a flexible premium, and you're able to receive income either for life or like a certain period, or you can have a lump sum withdrawal. And I remember there's actually someone that I know, this couple actually, they, back in 2006, they invested their money for years in the stock market, and they obviously lost money because in the stock market, it's, you're kind of taught, or even you're kind of set up to accept the fact that you're going to lose money and you're going to gain money. And so they definitely lost money. And before 2008 hit, and if we all remember, 2008 was when a recession happened. And so when that happened, right before that happened, they ended up rolling their money into, putting their money into an annuity. And they were so thankful they did that because that was right before they were planning on retiring in 10 years. And so they were just thankful that they actually put their money into a reliable product where their money was, they weren't going to lose their money, and it was guaranteed. And so they put that into an annuity. And so we see here, just to reiterate those points, these 3 main ways of how money grows. You have the fixed, which is safe. These are your CDs, your bank accounts, but there's a minimal growth. You have the variable, which is your stocks, which is, it's risky and there's a potential for growth. But then you have the index. This is where life insurance comes in, and the principal is safe, and also there's growth. So you're not going to lose money, and the money that you put in actually is able to grow.
Yeah, and I'll add to that because I was able to retire this year. One of the things that I did with the state of Florida is to roll my money over from the pension plan to the investment plan. And the reason why I did that is because I had already heard a lot of rumors about the pension plan. Like in California, the pension plan plummeted as soon as the pandemic hit. So even like today, you have a number of teachers who are over in California who are not getting their pension, monthly pension, because the pension plan plummeted. You know, we showed you a slide earlier that showed how we had over 137,000 pension plans, and now it's been dwindled down to only 37. And the other thing too is that with the state of Florida, we do know that the state of Florida's pension plan was up for discussion this year during the legislative session because they were changing their percentage. And so now there's a concern whether or not there will be enough money to be able to pay out those pension funds when it's time for those state workers to actually be able to use it when they retire. So one of the things that I've been learning, and then I even just got some information today that the teachers here in Leon County, you know, this has been on the agenda for quite some time where they're trying to get rid of the teachers' pension plan. And I'm like, I don't know why they would ever do that, but this is why we're here to talk about this when we talk about financial wellness, is because you need to be aware of what's happening so that you can start planning accordingly. So back to what I was saying is that I went, as soon as I retired, I had switched my money over from the pension plan to the investment plan because I was determined I'm not going to leave my money over there for the next 4 years and hope it's there when I get it. No, I'm going to play smart. So I roll my money over to the investment plan, and then after 3 months, you know, they require you to wait 3 months before you can pull the money out. I pulled the money out. I put the money in my own personal annuity plan with National Life Group. They have several different fit products. I love their products. One of the products that I used was called a Fit Certain Income. As soon as I roll my money over, guess what? They gave me a 15% increase right off the bat. That's like free money, okay? And then on top of that, they're going to give me a 6% increase every year for the next 10 years. Now, I've already used the rule of 72, and I have already found that in the year 12, I will have double my money. Well, guess what? I don't need to use the money until year 13, so I'll be 70 then. Okay, I know I'm dating myself right now. Yeah, in 13 years, I'll be 70. So I'm 57 right now. So I'm planning because right now in this business, I'm making enough income to be able, and it's so much easy work, but I'm making enough income with my business where I don't even have to touch the money. I'm not going to even touch Social Security. I hope it's going to be around when it's time for me to get it, but it's not guaranteed. But I'm putting some other things in place. So in the event that I can't get Social Security, I will have my own little nest egg. And I've already planned it where my annuity will be able to pay me for the rest of my life. The rest of my life is like 120 years. I do plan to live till I'm at least 105 or so.
It's good.
So I'm going to have money available, but I love the fact of knowing that I won't run out of money. So this is what we're offering you when it comes down to financial wellness. We want to be able to teach you, you know, how to protect your money, how to grow your money, and then also to help you to realize where is your money and is it in the right place. Like, for example, we talked about the term insurance. Yes, if that's all you can afford, then yes, it's better to have some insurance than no insurance at all. But if you can afford to do more of a permanent plan so you can start building equity for you, that's really what you want to do, because it feels good to know you have pockets of money that you can go and pull it out in the event that you have an emergency. For example, if, you know, let's just say you need, you know, there's something happened to your roof. You know, we live in Florida, so there's always hurricanes. I know we have insurance and so forth, but sometimes they don't come along as fast as we need them to. But let's just say something happened with that, or you might need something happen to your car where you need cash money to be able to take care of repair. It's good to know that you can pull money out of it so you can have it readily available, but then it's growing interest on it, so you're growing money rather than just having it sitting in the bank. Now, you know, this year I opened up a business account at a credit union. So they gave me this paperwork that talked about, you know, how much money I'll be earning by having my money in the savings. Do you know how much it was? 0.25%.
Oh my goodness.
not even a percent. Are you serious? You're going to grow my money at 0.25%. So this is why we're here, to help you, to educate you and tell you that that's not enough money to be growing, especially if you're going to have my money in the savings and that's all I'm getting is 0.25%. No, I'm going to put my money in something where I can grow money more rapidly, somewhere between 4 to 12%, so that I can maximize it. But then I don't have to worry about losing any money. So where everybody else is like, you know, running with their hair on fire, we can actually risk because we know our money is growing by the index and you never lose money. So we want to just say thank you so much for joining us for this presentation. We really, appreciate you listening. Again, my name is Coach Denise, and this is Carrie Godfrey. We've both been tag teaming to provide this information to you. If it is the case that you'd like to know more about what we do, or if you want to just sit down with a financial lifestyle strategy, please look us up. My email is php.coachdenise@gmail.com, or you can reach me by phone number. It's 850-445-5514. And Carrie, if you want to give them your contact information.
Definitely. My name is, my email is CARRIE. So Carrie.Godfrey, GODFREY @ymail.com.
Okay. And we'll be happy to sit down with you. Like I said, the service that we offer, there's no charge for it. One of the things we do like to do is help families, especially in the minority communities, because we've just not been afforded with the information that we've needed all these years to be better stewards of the money that we have in our hands. Money has a home, and so we're able to teach you where those different homes of money are. And also be able to show you how you too can leverage it so that you can grow, your nest egg or wealth that can be able to last for you during retirement and also be passed down to your family so you can leave them a legacy too. So I'm going to turn it back over to our host for tonight. We wanted to say thank you so much for inviting us. We really enjoyed this opportunity, and we just wish you well on the efforts and endeavors that you're doing with the health education and training with the city of Gainesville. We applaud your efforts, and I just want to say thank you so much.
Thank you guys so much.
Thank you.
I'm echoing. Thank you guys so much. I'll actually share your contact information with everyone through email, so they will get that through email, okay? As well as your
Brianna, you might want to turn your volume down some, and then Carrie, why don't both of us mute so she won't be echoing.
Can you hear me?
Yeah, I can. You'll need to probably turn your volume down so you're not echoing.
All right, guys, can you hear me now? Good. So thank you guys so much for coming out and giving this valuable information. Me, myself, I was not taught this in undergrad and graduate school. They don't teach you this. They don't teach you how to maximize your money in the right way, as well as what if there is a pandemic. We didn't know it was going to be a pandemic in 2020. These are uncertain times, so this information is very valuable. I know personally, I left the corporate world 4 weeks ago, and the Health Education and Training Center of Gainesville has been my full-time job. So I'm interested in growing this as well, my business, as well as my funds for my children to come, my family as well. So this is valuable and dear information that I think anybody could hone in on and use to their benefit. So I'm very interested in what you guys are doing. I applaud PHP Agency. This is really great work. So yes, I will actually give everyone your contact information and expect your phones to blow up because this is a really great a great tool to have. So thank you guys so much for coming out. I applaud your work and your efforts. This is awesome.
Thank you so much for having us.
Yes.
Yes, thank you.